Hi, how's everyone doing? I hope you guys are all well and healthy and strong. Well, today we're going to talk about derivative, chapter 3. Okay. So, what's derivative? It is a financial instruments where it based on some underlying assets. Okay, so what are the underlying assets? Like stock and shares, like indices, STI indices, Dow Jones index, right? Bond, treasury bonds, interest rate from different currencies, and it could be also based on some commodity price, such as corn or oil. So if you look at derivative, it's actually a contract to purchase an asset sometimes in the future, right? In fact, in the recent years, derivatives have become a favor for most of the investors, right? There are four basic things in this agreement or in this contract. They are basically the underlying interest or what's the underlying assets that the contract value is based on, and also the quantity, right, or the amount, as well as most important, what was the sales price. So there's also the expiry dates on the contract. Derivatives is essentially like what we say, an agreement between the buyer, a future buyer, and a future seller that specify a future price that they're going to commit to, right? So they basically try to fix the price in the future, right? So the items, as I mentioned, is the underlier or the underlying assets. So it can be based on corn, natural resources, gas, sugar, oil, stocks, government bond, etc. In these particular modules that we're teaching you, we'll basically be focusing just on the four basic derivatives: the forward contract, the future, the swap, and the options. Right? We'll basically briefly touch on these few derivatives today. We will go in depth in the following chapters. So where can you get all these futures contracts? You can actually trade them on Singapore Stock Exchange, Chicago Mercantile Exchange, New York Stock Exchange, etc. So these are quite a few places that you can actually find future trading taking place. So with the four derivatives that we're looking at, there's definitely some differences and characteristics we will basically be dealing with. Right? For example, a forward contract will be the first derivative we'll be looking. It's highly customizable. And future contract. Swap is basically quite the same as forward contract, and they do swapping of contract, right? Swapping. Forward, future, and swap, they are basically future transactions. They talk about commitment, which means that it's unlike options where there's no commitment, right? Which means forward, future, swap, they have to go through whether they like it or not. Option, on the other hand, is there's an options. We will talk about this also. So options, there's options to say I don't want to go through these transactions. So there's no obligations. Whereas in forward future swap, there's certain obligations that everybody, the both parties has to commit, right? To again to something in the future transaction, a future price that they have commit to. Future and options are more liquid, okay, because they are based on standard items, standard contracts. So if they are easily tradable on any exchange, whereas forward and swap, they are basically more customizable and they are more personalized. So they are usually traded over the counter. So there's just some differences over there. So basically these slides talk about some of the differences and similarities of the various derivatives, four derivatives that we will be looking at. So what are the use of this derivative? Right? People use it to hedge certain price. Like for example, farmer, right? They use it to mitigate certain risks, right? Like they harvest the corn and takes time for them to grow and harvest. So they like to fix the future corn price, right? So they usually go into some forward contract, right? So in a way, it's like hedging a price in the future, and that help them to reduce some of the risk. Speculations, yes, there are some gambler who like to speculate and bet on the price of something, right? We'll talk about this. And there are also people like to fix a price in the future or fix a good price in the future so that they can get a cheaper rate, right? And they have uh, more, more control in some of their budgets. So some actually go uses derivative to get through some loophole because of some regulatory. So let's look at this hedging. How do we do hedging? Right, just now I already mentioned farmer. We have seen the earlier case. The farmer use is like a hedger. They like to manage some of the future uncertainty because of the fluctuation of prices in the futures. Sometimes the corn price can, for example, can go up or can go down. Right, so that creates some uncertainty in the market. So uh, generally the farmer like to have a fixed selling price in the future so that they know that in the future there is something that is profitable, right? They usually like to set a price that is higher than their operational cost, right? So they usually generally go into a forward contract or future or sometimes options, right? Options that they can also look into, right? So generally, a hedger is somebody who try to go into this derivative market to reduce their risk. So that's mainly their purpose in doing that. So let's take a look at one example, like ABC mining. For example, this mining company, a small mining company, they like to to produce gold, right? They like to mine for gold, and hopefully in the next 10 years they will be able to sell some gold at a good price, right? So for example, the current gold price is about this 1,640, right, per ounce. And if they were to produce, right, it's going to cost them $1,000 per ounce, right? Uh, so so if they definitely have a profits there, right? If you can see, right, this is their cost price and these are their selling price, right? But you can't be assured that the gold price will always stay at higher than the production price, right? Because over like the next 10 years, right, things can change. A lot of things can change. Like you can see now we have the COVID or the virus coming, right? Generally cause a damper in some of these commodity prices, right? So of course, some of these companies like mining industries, they like to ensure that at the end of 5 years, when they dig enough gold or they be able to find enough gold, then they can still sell at a gold price that is higher, right, than their production cost, right? So that's where they are coming from in the mining company, where they hope to hedge the selling price above their cost price, so that they can be assured of a profit, reasonable profits, right? So that's one way that they, like I say, want to hedge any of these price risks by using financial derivative. Right? So it's all about fixing a future price. It's all about buying like insurance, right? In case there's some drastic price movement that you find that by the time they can sell their gold, the gold price is has dropped below 1,000, below their cost price. So they'll basically be making a loss, right? So this is like they might as well don't produce, right? They don't produce gold because it's meaningless. So sometimes it's better to don't produce, stop the productions, and then you don't have any of these operation costs to deal with, right? If the selling price is going to be lower than your production cost. So another derivatives that is being used, other than being a hedger, right, to hedge the price, the future price, there are also these speculators, right? The speculators, like I just now mentioned, is like gambler, right? They go into the derivative market to basically try to uh, make some profit, potentially try to uh, profit, to find some gain that they can get out of it, right? They are not there to reduce financial risk, but they try to play the risk and try to hopefully make a gamble. Like most people will think that the market will go down, but as a speculator, they will just speculate that no, I don't think the market will go down, it will go up the other way, right? And then they would take the risk, and hopefully the market will turn the other way, and that's where they can profit from it, right? So it's actually very important to have these speculators around, because without these speculators, then the hedger, okay, will not have anybody to sell to. So speculator and hedger they complement each other, right? If there's some if they want if the hedger want to sell something, there's a speculator who willing to buy, right? Or if the hedger want to buy something, then there's a speculator who are willing to sell at the price, right? So they are basically counterpart to each other, in terms of trade. They need one another, right? Otherwise, without them coming to a match, right, you will never have a transactions that can go through. Right. Another use for the derivatives is by the banks. Okay, the banks, they have a lot of financial instrument. They offer a lot of financial insurance. They take on a lot of risk. They lend money, right? They take on a lot of loan also, right? They do money exchange. They do all kinds of transactions. So the banks are basically managing a lot of risk. And since they are having a lot of this risk, they will try to, like I say, mitigate the risk by getting some of these derivatives, right? So they will likely be using some of these interest rate derivatives, currency derivatives, as the exchange currencies will always fluctuate by the day. So there are a lot of risks they have to undertake, and they got to buy insurance. So this getting these derivatives, creating these derivatives is also another opportunity for them to earn money, right? And also to manage the risk in some of this area, especially the bank are highly regulated by the government, which means the government has to control the bank, that they must have at least a minimal amount of capital in there, right? So they have to watch over some of uh, this some of the budgets that they have, and some of the money or deposit that they have to oversee, right, to ensure that they can continue their operations, right? All banks, they must keep a minimum basic capital, right, in order to run the banks. Manufacturing companies, they also use derivative, right? Like I say, manufacturing company, they buy lots of raw materials to produce good and also sell their end product to the global market. So they use a lot of these commodity pricing derivatives, as well as they do international business, so they need currency derivative. Right, market maker perspective. So there are the intermediaries, the middlemen, who basically trade this derivative. So essentially, this middleman, they will buy derivative from the customer who wish to sell them, and then try to sell them off to customer who wish to buy them. Right, so it's like a middleman. So they try to chart the differences, which is the spread. That's where they take profits, and they use it to buy low. It's basically using the rule of thumb: buy low and sell high. Okay, so basically this is a part one. I will end here before the times end.